Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Again, here when we look at the spreads, we have the ETF spread of 9 cents. We have this basket spread of, we'll call it 4.25 cents, 4.2 cents. Okay. Now I'm going to flip over to the component page for BIC. And this is essentially what we saw with FIW, except it's a little different because we are dealing with local shares. I've kind of normalized everything to US dollars. So this column D here with this FX rate, where it says USD, these are ADRs, as you can tell by the names, ADRs, GDRs. We have, of course, local Brazilian shares. We have local Korean shares. And then here we have some local Hong Kong shares. Okay. Now, one of the things which is interesting about this, right? When I spoke earlier about the creation redemption process for FIW, for PHO, those funds are funds that invest in U.S. domestic shares only, right? So, as long when the ETF itself trades is when those underlying components trade. So the creation redemption process is fairly straightforward, right? The authorized participants, the market makers will go out, buy that basket, and then deliver it to fulfill their obligation. And when you start getting into global markets, that becomes a little more difficult. Sometimes simply because maybe those markets aren't open when we're open, like the Korean markets. Maybe like the Brazil markets. Those are actually both Korea and Brazil are a type of market known as an ID market, which means that they do not permit in-kind transfers of equities. So even if you had a participant who went to the local Brazilian market and purchased the portion of the basket that they need to fulfill the trade, they actually would not be able to, legally, they would not be able to transfer in kind those shares to First Trust to get the shares of the ETF. So what ends up happening is that due to issues of market, the timing of markets being open, and issues like ID markets, sometimes, depending on what the makeup of, say, an emerging market fund is or some kind of global product, a lot of that creation unit is actually delivered to the fund issuer in cash. All right. So when you look at this basket here, and I'll scroll down a little, you can see that there indeed are some of these prices moving. Right. Brazil markets are still open. Obviously, the U.S. markets are open. Korea, they're not open. So you're not going to see these price changes come through in these Korean stocks. What you are going to see, though, is the fluctuation in the currency, right? Because currency trades 24 hours. That fluctuation in the currency will be represented in the portfolio. So even though we're not getting updated shares and share prices, we're still realizing the effect of currency movements on this basket. Okay. Again, these U.S. dollar priced stocks here, they're open as the markets are open. So let me just take a moment here just to gather my proverbial thoughts. I don't know, Katrina, I don't know if there's any questions at this point, or.
We actually did have a couple of questions in the Q&A window. Katrina asked if there was any correlation between spread and volume.
Well, generally, the tighter something is priced, the more that it's going to trade, right? It actually gets interesting because sometimes there are exchange-traded fund products which launch and they really take off. Recently, this summer, we launched the First Trust IC Cloud Computing Index. And, within a couple of quick days, assets in the fund were up around $40 or so million. Now, that's a product that, hadn't even existed a couple of days prior. But with the trading activity, it's kind of a chicken and egg thing with trading and with markets. When you try and bring a new product to market, it's always tough because the market maker just basically doesn't want to quote something that isn't traded, and people don't want to trade anything that doesn't have tight markets to it. So I would say that one of the key items that you would need to facilitate the success of a new product, or really any exchange traded fund, is a good and tight market. So there are, of course, a lot of other things that go in with that in terms of the suitability and timing of the launch and all these types of things. Generally speaking, at a high level, though, yeah, if you have tight markets, it's almost an incentive for people to trade, even though, quite frankly, they can make their own tight market just by trading with a limit order. So.
Okay, it looks like we have another question also from Carol. She asks, are you going to talk about how ETN issuers hedge to provide the benchmark index return?
Sure, we can talk about that. So an ETN is another type of what we'll call an ETP, an exchange traded product. This is an unsecured senior piece of debt that generally banks will issue, but a bank will issue on their own full faith and credit, and it is listed on an exchange. And so what they offer is they will say, we will provide X times the return of some underlier, and you will get that on some periodic basis. We just did actually some business with UBS, where we launched with them a solid state drive based product, kind of a niche, but they launched a one times product on this index, and as well a two times product. And so what they are doing is we put together this index, which is an equity-based index, and they have decided to, on a monthly reset basis, provide their returns associated with the index. And so what they're doing is they entered into a swap with ostensibly another part of the bank, but that part of the bank which is putting on the swap is hedging their position by basically taking the other side of that of the swap. So when it comes to ETNs and how they are issued, unlike in an ETF where you're purchasing shares or participation in a portfolio of equities, mostly equities, with an ETN, you're actually buying into part of a debenture, right? You're basically buying a bond. It's just that instead of some kind of a fixed rate, what that bond is tied to is going to be some function of an underlying index, right? And for our purposes, for this, for the solid state drive product, it happened to be an equity-based index of manufacturers of solid state drives. Okay. So, this is kind of, like I said, I went through the domestic equity, talked a little bit about global equities. One of the things which is interesting too about the global piece is that because market makers, they don't want to have an unhedged position, and everybody kind of wants to cover all their bases when these trades come through. A lot of times, they will look to transact, not right at say 3 o'clock or so, but they will actually notify the issuer earlier and say, we would like to do, X creation units, or we need Y redemption units, and they will actually look to trade, on kind of the closing prices or the NAV of a particular day. So for instance, when that $1.2 million trade came in, sorry, that 1.2 million share trade came in BIC about a year or so ago, that was actually something where the person making the trade reached out to the issuer really kind of a couple days in advance and said, look, we want to make this allocation to your fund. And they actually worked that trade over about a day and a half to arrive at the execution price. And then once that went off, then the shares were delivered, the underlying component shares were delivered, and then of course the shares of the fund were adjusted accordingly. So, all right. So I don't know, Katrina, if there are other questions at this point, or.
Actually, it looks like we do have one more question from Carol. She says, so inverse and leveraged ETNs have less decay than the corresponding ETF?
Sorry, when you say less decay, how do you?
Yeah, I'm not sure.
That was the question. So they have less decay, meaning they have less tracking error. Well, yeah. I mean, they technically they have zero tracking error because there's no friction or slippage in terms of having to go out and execute at a certain price or kind of deal with bid-ask spreads. I mean, on the hedging side of the equation, yeah, they have to deal with that. But what's delivered to the shareholder is pretty much exactly, less the expense ratio, but exactly what the issuer is saying. Right. Like I said, because you're investing in part of this really, piece of debt, this note, if just like any other bond, if they were to say this is a 5% bond, well, your coupon's going to be that 5%. In this case, what they're telling you is we're going to give you a percentage which is based on, rate of change in an index, and all they're doing is taking a piece out in terms, with respect to the expense ratio. So tracking error on ETNs is virtually nil. Again, save whatever tracking error is introduced because of the expense ratio.
Okay, great. We probably will have a few more questions throughout, but we can just hold those till the end.
Okay. All right. Well, honestly, Katrina, I think I've actually kind of talked my way through here. I think, unless folks have questions on, more about the creation and redemption process or anything else. I mean, I believe it or not, I'm actually kind of set.
Okay, great. Let's see if we had any other questions. If anyone has any questions, feel free to share them in the Q&A or the chat window, and we'll pass them along to Mark. Let's see. I think Paul had a question. If a fund needs to be wound up, what needs to be done in order to not harm the shareholders?
Meaning, so a fund has to close. We see this is interesting. I don't think that there would really be anything that would hurt shareholders. If when you look at, say, closed-end funds, a lot of times those fall into a state where there are discrepancies. Mostly they trade to discounts to NAV. And depending on how large the discount is, it can be problematic, and we see that there are a few players. What they specialize in is basically purchasing up enough of these funds and then forcing the board to make changes, perhaps even open-end the fund. And the theory is that then once they open-end the fund, everything goes to NAV, and all those that discount is eliminated. In terms of an exchange-traded fund, shareholders really aren't impacted that much because, again, in the same way that we talk about here, this basket percentage of ADV, all right, if you look on the page here, basically, for instance, if FIW were to liquidate tomorrow, there might be some names that might have some impact to their prices. But generally, what this number here, what this 1.19% is telling you is that if the fund liquidated everything it owned, the trades in all of those names would on average be about 1.2% of the total ADV. So essentially, the regular trading of these names would just absorb those trades, and there wouldn't really be any impact. Trying to think. What ends up happening sometimes, not necessarily to investors of the funds themselves, but when you start to talk about options on those funds, depending on what the fund is doing and how they proceed with the liquidation, that might have an impact. Sometimes what the OCC will decide to do is basically implement early expiration. And so if you have a situation where, say, a fund is going to close in November and you're holding, March dated options, well, when you bought those options, when you put those positions on, you were buying a lot of time value. And basically what happens is that time value disappears because the fund disappears. And so people can get hurt doing that. But in terms of direct investors into the ETF, I can't really see that there's a lot that can happen that would quote injure them or hurt them by holding the fund up until the point where it liquidates. And there's no extra fees or anything like that that happen as a result of the liquidation. So.
Okay, and I guess related to that somewhat, Randy asked, are all of these ETFs sold like stock or some only settled at the end of the day?
Well, all these ETFs trade like equities, so they open at 9:30 and they close at 4. And whatever price if you go in and put your order in at 1:55 in the afternoon, I mean that's the price you're going to get. That's part of what makes these products so attractive, right? It used to be that if you wanted to transact in mutual funds, you put your order in at some point during the day. The NAV would be struck based on 4 o'clock prices, and then the next day you would see it flow through to your account. Of course, there are all kinds of things that happen in the background, and frankly, there are a whole bunch of limitations on what you as an investor can do, right? We all know that the industry went a little crazy and still is a little crazy with short-term redemption fees, steep fees. Mutual fund companies holding lists of investors that they're basically blackballing and not allowing them to trade in their products. You take that in conjunction, not in conjunction with, but you take that and kind of juxtapose it to exchange-traded funds. These are the kind of the standard talking points about ETFs. In an ETF, you know exactly what your portfolio is holding every day, and not 45 days after the quarter end. Your expenses are lower as a function of the redemption, the creation redemption process. And you as an investor can basically, you get to pick your entry point, right? So, back in the day, but if you're a mutual fund holder and the market is tanking and you want to get out, you can put your order in, but it's going to get filled at the close price, right? If you're in an ETF and there's some fast market action that you want to avoid or take advantage of, as soon as you make that trade, you own it. Or as soon as you make that trade, you're out of your position. So yeah, these are continuously priced, and they price and trade, just like equities, right?
Okay, I think we have time maybe for a few more. James asked, for a small trader looking for liquidity, a small spread is still the thing to look for. Is that correct?
A small spread is desirable, of course, but don't forget about, your best friend in the world, the limit trade, right? If you're looking at two stocks, or if you're looking at two ETFs, and you like ETF A over ETF B, but ETF B has a tighter spread, well, guess what? You like the one that you like. You want that for your portfolio. Just because it's 8 cents wide or 20 cents wide. Again, the bid-ask spread, these are kind of like MSRP prices, right? If you don't like what you see, if it's too wide, if you don't want to pay that 20 cents wide, tell the market maker, hey, I'll pay 13 cents wide, and see what happens. Of course, if you're talking about the difference between something trading 3 cents and something trading a penny, probably not going to get anything on that, right? But again, if you like a fund, you like its profile, make the trade. If it's a penny, or two off from a competitor product or some other product that you like less, frankly, I would say don't worry about it, because part of why you're choosing this other product is because you like the return profile, you like the risk profile, and it's a fit for your overall portfolio. Right? So, yeah, don't forget about the limit orders. A lot of people just look at the market and say, oh, it's too wide, I can't trade this. Yeah, they're a limit order.
All right, I'm checking to see if we have any more. Actually, let's do one more question. Milton asks, how do you determine which options might be interesting?
How do you determine which options might be interesting? Wow. I don't think I have 8 hours. In terms of options, I mean, you really got to look at there are a lot of variables to look at. It depends on what you want to do. Say you have a position and you want to try and augment it. You could sell calls on it. You could sell puts on it, depending on what your view of the direction of it is, right? If you're a holder of SPY and you have the firm belief that SPY is going to go down, well, to take advantage of that, you could either buy puts to hedge your position, or you could sell calls, which would give you some additional income, right? And of course, there are any number and many different strategies that you can enact. It's just a matter of your understanding of the markets of your underlying, your understanding of options, and primary of that is the understanding of the volatility of your underlying. All right. It's one thing to have an opinion about the direction of a move. It's one thing to have an opinion of magnitude of that move. But when you start talking about options and you can't articulate your opinion on volatility, then you shouldn't be in that marketplace. Right? So direction, good to have. Magnitude, definitely, that helps and that informs you on what you want to do. Have to learn about the volatility of the underlying that you're considering either writing contracts on or buying contracts on.
Okay, let's see. Do you think we have time for one more?
Oh, sure.
Okay, we actually have a few more. So sorry to anyone if we didn't get to your questions today. If you do want to share your questions and you definitely need an answer, feel free to email us at webinars@issy.com, and we'll try and get to your question one way or another. But John asks, pardon my ignorance, but why are institutions blackballing certain potential investors?
In the mutual fund area, and I just as a bit of background, I used to work at a few shops. I worked at the Luma Sales in Boston, and I worked at Fidelity. up there as well. And what ends up happening in the mutual fund space is that in investment managers in general don't like so-called hot money, and there's a few reasons. Part of the reason is that it creates a situation. I mean, they're paid on the assets under management that they have, right? So if they have a lot of fast money coming in and out of their portfolios, it doesn't help kind of their bottom line, right? And while that plays into it, what really drives this is that when there is a lot of trading and there's lots of activity in a mutual fund, it creates a lot of expense, right? And if I have somebody who's darting in and out of traffic, so to speak, with their money, it creates a lot of expense that the remaining shareholders of the fund have to bear. And so mutual fund companies will say, and they do, and rightly so, that we don't want people moving in and out of our products quickly because it creates a lot of expense, which A, creates a drag on the returns of the fund and is burdensome to the shareholders that are not doing that, which are kind of good long and hold buyers of these products. And again, because in the mutual fund world, you basically have to go to the issuer to get your shares. If you are, someone who engages in a lot of quick trades and is trying to kind of do the equivalent of day trading or short-term trading in the funds, those companies will, like I said, they have lists of individuals who say, no, you create too much cost for our other clients, and quite frankly, you're a pain in the butt. So we choose not to deal with you. All right.
Okay, I think that should about do it. Again, anyone, if we did not get to your question, feel free to send us an email at webinars@isc.com, and we'll make sure to respond. So I guess we'll just wrap things up. Our thanks to Mark for sharing your insights today. Thanks to all of you for joining us at this special time. To learn more about the ETFs that we discussed today, including FIW and VIC, which we discussed earlier, please visit isc.com/ETF. You'll be able to find more product info, articles, and a link to sign up for free trade alerts that can help you learn how to best trade these ETFs. We do have a lot of resources available on our website, so if you're looking to trade products based on these industries and sectors, make sure to check it out and take advantage. If you do have any questions or comments, feel free to send an email to webinars@isc.com. Thanks to everyone for joining us this afternoon. We hope to see you back next week.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.